Oklahoma cigarette stamp, and unstamped tobacco products, tax bond. What is the Oklahoma cigarette stamp? The Oklahoma cigarette stamp is a small label affixed to cigarette packs or other tobacco products sold in the state. It serves as evidence that the required state taxes have been paid on those products. These taxes help fund important public services like healthcare, education, and infrastructure. When tobacco products are sold in Oklahoma without the proper stamp, it means the state isn't getting the taxes it's owed. This can lead to significant revenue loss, which can impact the funding of essential programs and services. Why is the cigarette stamp important? The cigarette stamp is essential for several reasons. Revenue collection. The taxes collected from cigarette and tobacco sales contribute to the state's revenue. This revenue supports various public services and initiatives that benefit the community as a whole. Preventing smuggling and tax evasion. Without the stamp, there's a risk of illegal activities, like smuggling and tax evasion. Criminals may attempt to sell untaxed tobacco products, depriving the state of revenue and creating an uneven playing field for legitimate businesses. Public health. High cigarette taxes can deter smoking, leading to improved public health outcomes. By ensuring that all tobacco products sold in the state are properly taxed, Oklahoma can discourage smoking and reduce the associated health risks. Why is the bond required? The bond requirement serves several purposes. Compliance assurance. By requiring a bond, the state ensures that sellers of unstamped tobacco products are financially capable of meeting their tax obligations. This reduces the risk of tax evasion and non-compliance. Revenue protection. In the event that a seller fails to pay the required taxes, the bond provides a source of funds for the state. This helps protect the state's revenue and ensures that essential public services continue to be funded. Consumer protection. The bond requirement helps protect consumers by ensuring that sellers operate responsibly and comply with tax laws. This promotes fair competition and prevents consumers from purchasing untaxed or counterfeit tobacco products. How does the bond work? When a seller applies for the $25,000 bond, they typically pay a premium to a surety company. The surety company then issues the bond, guaranteeing the seller's compliance with tax laws. If the seller fails to fulfill their tax obligations, for example, by selling unstamped tobacco products or failing to remit taxes to the state can make a claim against the bond. The surety company will then compensate the state up to the bond amount, ensuring that the state's revenue is protected. To know more, please visit swiftbonds.com.